What I do want to go over with you guys is just some acronyms. So in the real estate industry and the mortgage industry, there's a lot of different what I call acronyms in the game, right? You guys will hear LTV thrown around, DTI thrown around, DU, ECOA, RESPA, TILA, and you're like, what is going, like, what do these mean? And in the exam, a majority of the time, it could work both ways. They may ask you a question where it's spelled out, and then they will likely ask you a question within the acronyms. So you guys want to make sure that you know an understanding of the two, so you're not surprised when you're asked a question and you have that understanding of what it covers. So we'll go through this one really quickly, and then we'll get cranking away with the first section. So the first one, AFBA, affiliate business arrangement disclosure. So, and you guys can unmute yourselves for this part, because I will kind of ask you some questions. But so affiliate business arrangement disclosures. So what do we usually think of when we hear affiliate business arrangement? What do you guys think?
It's when you have another business or I guess another partner that like you work with.
Correct. So you have another business that is affiliated with this arrangement, with this transaction, right? So that must be disclosed. So a lot of instances in these scenarios, you'll have generally an attorney who's affiliated with the title company, right? Happens all the time. Nothing wrong with that, especially how the industry has shifted. Title companies act as what's called the settlement agents. In a lot of instances, the attorney will have some type of ownership percentage in it. So in order for this affiliated business arrangement disclosure to be disclosed, what do you guys think? And this is where a lot of students get wrong. What's the minimum percentage of ownership that somebody may have in a business that this disclosure must go out? What do you guys think?
Am I allowed to answer too?
Yeah, if you guys want, absolutely.
1%.
1%. So a lot of students in these examples, some people may say 25%, right? How many people off the top of their head thought 25? Nobody. Okay, good. You guys are good. So 1%. So think about it. If I have an attorney who's getting paid for their services rendered for one business, wouldn't you think, and again, there's nothing wrong with it, but wouldn't you think you would also want to know that an attorney is systematically, potentially getting some type of benefit also from the title company? Sure, nothing wrong with that. And what's the minimum percentage that you can have in a business of an ownership percentage? 1%, right? So 1% is the minimum percentage of ownership that must be disclosed. And ALTA is called American Land Title Association. That's just essentially the breakdown of the fees from the seller's perspective of what they're netting, all the costs, transfer taxes, seller, wire, commissions, and so on and so forth. APR is also known as the annual percentage rate. The APR will generally always be higher than the interest rate because the APR is the total cost of the entire transaction of what the rate would be, including closing costs, finance fees, and so on and so forth. Okay. If you guys ever get asked that question, APR is generally always higher than the interest rate, mainly because it's the total cost of fees wrapped into the loan. ARM mortgage, you guys should have gone over it. That's also known as an adjustable rate mortgage. So, and remember with an ARM mortgage, a couple of key things you guys want to remember. Adjustable rate, meaning what? The rate is not fixed. It is adjustable. The first rate that you get, you guys can write down, is called a teaser rate. So what happens when you get, again, keep this professional, but when you get teased, right? You're like, hey, I want it, and you'll get it, but you can't get the whole thing, right? So you get teased. It's a teaser rate. And then you also have what's called the index, which is where the percentage of change, the margin, which is how many times it can move, and then you have the ceiling or the cap, which is the basically the max that it can go up. Okay, So remember those terms, guys. You have the teaser rate, you have the index, you have the margin, you have the cap or the ceiling, whatever they're called. You also, with an adjustable rate mortgage, you can have a conversion where you can basically convert your adjustable rate mortgage to a fixed rate mortgage. You generally usually have a specific time frame to do it. CD, also known as the closing disclosure. This used to be called the HUD 1 previously, and they changed the word to the closing disclosure. Closing disclosure basically just gives an understanding of what the total closing costs, mortgage payment, interest rate, specific fees are being associated, any sellers, transfer taxes that you may have to pay. Usually in New Jersey, transfer taxes, depending on if it's negotiated during attorney review, is usually paid by the seller. But closing disclosure breaks that down. You guys all should have went over in the book. You guys were going over in the book kind of how a loan estimate or a closing disclosure looks like. They're actually both the same thing. It just, loan estimate is an estimate of the numbers. Closing disclosure gets to be a little bit more in detail as to where it's at. CFPB, these are the big guys, the Consumer Financial Protection Bureau. The Consumer Financial Protection Bureau came about and they basically all dissolved a bunch of large agencies, and they're the ones that make sure that the federal laws that were instilled, such as the SAFE Act, TILA, RESPA, Dodd-Frank, Gramm-Leach-Bliley, is all being followed, and there's no predatory lending occurring. The CHARM is a consumer handbook on adjustable rate mortgages. If a consumer is interested in getting an adjustable rate mortgage, they must receive this, the CHARM, the consumer handbook on adjustable rate mortgages, that gives them an idea of what they're getting themselves into, what they should be aware of, what they shouldn't be aware of, so on and so forth. Combined loan to value. So you guys remember when you went over that in the prep, it's, you always have LTV or CLTV. LTV is there's one mortgage, and it is what you're buying the house for and what it's worth versus what your loan amount is. Loan to value, then you divide the two. So let's say you have a $500,000 home and you're putting, let's say 20% down, that's 100 grand. So you do 40,000 divided by 500,000, right? Your loan is 40,000. Your value, you would hope, is 100% of the sale price, 500,000. 400 divided by 500 gives you what? 80%, right? That means that the client put 20% down. COFI, again, just your cost of funds index, where the numbers are pulled from. CRV, certificate of reasonable value, where it's basically a confirmation or a review from the appraisal. DU, you guys will hear this word thrown around a lot. This is desktop underwriting. So everybody here remembers the secondary market, Fannie Mae and Freddie Mac. You guys remember that stuff? So those are two of the largest secondary markets, which basically buy a lot of the loans. Fannie and Freddie are the ones that put specific minimum requirements for banks to abide by, such as credit score, debt to income requirements, and a lot of other variables. I could be here for hours talking about. DU is after you've plugged in everything in a system, it reads it based on what you put in as the originator and spits back out what's called a DU approval. And it'll either be approved eligible or what's called refer with caution, meaning it's denied, or approved ineligible, meaning, hey, there's a potential for this file to get approved, but you have to look at 1, 2, 3, 4. Okay. That's a desktop underwriting. Okay. And that's desktop underwriting is through Fannie Mae. And we'll go through what LP is through Freddie Mac. ECOA, Equal Credit Opportunity Act, Regulation B. Self-explanatory, right? You want to equal credit. Regulation B, I want you guys to remember B equal, right? So that's what ECOA stands for. Regulation B for B equal. In the exam, they can present it to you in 3 different ways. They can present it to you as Regulation B. They can present it to you as ECOA, or they can present it to you as Equal Credit Opportunity Act. So make sure you guys remember the verbiages for the actual spelling, the acronyms, and then the letter of the specific regulation it may be associated to. BACTA, Fair and Accurate Credit Transactions Act. So when we think of accurate credit, what do we usually think of? Something being reported correctly, right, on your credit report. So FACTA, when I want you guys to think of FACTA, or the Fair and Accurate Credit Transaction Act, I want you guys to think of identity theft, okay? So any identity theft that may be occurring generally will be protected under FACTA. If I'm going fast again, please stop me, guys, but we got a lot to cover, so I want to make sure we grab it all. FCRA, Fair Credit Reporting Act. So when we think of reporting, we want to think of something being reported accurately, right? And then Regulation V. So for Fair Credit Reporting Act, also known as Regulation V, I want you guys to think of V as verify, right? So we think of reporting, we want the information to be verified, Regulation V, okay? FEMA, this is Federal Emergency Management Agency. We are going to see FEMA a lot in the news, and you guys probably already seen them a lot in the news, really recently, especially in New Jersey. Are most of you guys here from New Jersey? Majority of you guys? Yep, awesome. So you guys remember last September, we had Hurricane Ida, which like came completely out of left field, right? We were definitely not ready for it, and not getting into politics, but hopefully we will be next time. But a lot of sewage backup and stuff like that, and then there was a lot of floods everywhere in areas that there normally isn't floods. So you guys remember when we went over flood maps and the specific zoning of flood maps, right? Where you have different areas where it could be flood zone A, X, Z. So I have a very strong feeling after Hurricane Ida, FEMA is going to now come out, or however the procedure is, and actually redraw a lot of the FEMA maps, because some areas like, and again, I could be wrong about the areas, don't hold me to it, but Linden, Elizabeth, Rahway, a lot of urban areas who necessarily usually don't see that much flooding got crushed, right? So I think FEMA now may step in and redraw these maps. Now, simultaneously, when you're getting a FHA loan, if you are in an area where it's in a flood zone, a consumer must have flood insurance, right? That flood insurance must come through FEMA, because you're getting a government endorsed sponsored loan, must also get the coverage of insurance through them. It cannot go private. FHA, Federal Housing Administration, you guys all remember this. You probably heard it a million times even before you took this exam. FHA loans, Federal Housing Administration, usually a couple things I like to have our students remember. One of the benefits of an FHA loan, you can get 3.5% down payment. If you guys remember, the debt to income ratios is a little bit higher than a conventional, right? Who here remembers the debt to income ratios for an FHA loan?
3143.
Very, very good. Super important for you guys to remember these ratios, because you want to be boom, boom, boom right off the top of your head. And what is it for conventional, Stephen?
2836.
Awesome. So very good. So you guys see 28 for conventional, 31 for FHA. So there's a little bit of room. And you might think, oh, it's only 3%. That 3% can make or break a deal. And then you have 36% on the back end for conventional and 43% on the back end for FHA. That's about a 7% difference. So you'll run into a lot of scenarios where a client may have good credit, may be good, but debt to income ratios, he just has too much revolving debt, or he might just be borrowing a little bit more than he could based on his income capacity. You would recommend them to go an FHA route and then eventually into the future refinance, right? So very good. FHLMC, also known as Freddie Mac, also known as Federal Home Loan Mortgage Corporation. This is, again, like the brother, mother, sister, friend, cousin, whatever you want to attribute it, of Fannie Mae and Ginnie Mae, right? They also buy mortgage loans and they pool them. Freddie Mac what they do is they use, you guys remember we were going over DU for Fannie Mae? Freddie Mac also pulls what's called LP, loan prospector. Okay. FNMA, we went over. Fannie Mae, one of the largest secondary markets. They buy a lot of the loans. So a lot of mortgage lenders need to conform their guidelines off of Fannie. FTC, Federal Trade Commission, self-explanatory. All of us have heard of the FTC before and the regulations that they instill or look over. GFE. So GFE, also known as good faith estimate. This used to be there. Now they've changed it to what's called the loan estimate. Okay. So in the exam, you may see it come up as GFE or loan estimate. They're synonymous within the two. And they're that document that we looked at that breaks down the estimated closing costs, estimated cash to close, interest rate, payments, so on and so forth. Graham-Leach-Bliley Act. What I want you guys to remember with the Graham-Leach-Bliley Act is SPF. So what do we think of when we put on SPF? Who wants to remember? Summer's right around the corner. I can't wait, right? What do we think of when we put SPF?
Protection.
Safety, right? Yeah. So you don't want to get, especially like me, I get crushed in the sun, right? I gotta put sunblock. I want to protect myself. So the Graham-Leach-Bliley Act is about protection. So I want you guys to remember this. The S stands for safeguards. The P stands for privacy. And who here remembers what the F stands for? Nobody. So S stands for safeguards. P stands for texting, and then the F stands for financial privacy. Okay. So safeguarding, pretexting, financial privacy. Okay. When we think of Graham-Leach-Bliley, think of SPF. Those are the three things covered within. GNMA, also known as Ginnie Mae, Government National Mortgage. They're the ones that pulls all the mortgages together. GSEs, the government-sponsored entities. Those are the three: Ginnie, Freddie, and Fannie. HELOC, home equity line of credit. Those are usually a second mortgage that goes on top. It's kind of like an American Express. It's a line of credit that you take on your home. If you use it, you have to pay back a specific payment for that line of credit that you use. If you don't, there's no payment warranted. HER, also known as home expense ratios. Remember, guys, it can also be known as a front-end ratios. Who remembers calculations for that? Excuse me. Housing expense ratios. That was what? Fuck. You guys remember the what's the word? The formula? No. So you Steven shared with us the ratios, right, for conventional and FHA, 2836, 3143. So 2836 is for conventional. So 28% is the front end ratio. And this part's important. That is your mortgage payment or your PITI, PITI, divided by your gross income. Okay, make sure you guys remember that. So the 28 from a conventional or the 31 from an FHA is your front end ratio or your housing expense ratio. And that is your mortgage payment only or your PITI divided by your income. That percentage may not exceed, again, from the from the guidelines within the book, 2836 conventional, 3143 FHA. I'm not going to confuse you guys right now, but the reality of the market right now, there's what's called a QM patch. So it's actually a little bit higher. Not going to tell you what the actual ratios are, but purposes of the exam, 2836 conventional, 3143 FHA. Okay. HERA, Housing and Economic Recovery Act. You guys went over with Jay. HMDA, Home Mortgage Disclosure Act. Remember, the Home Mortgage Disclosure Act must be done when you're submitting an application. You're disclosing things to a mortgage loan originator, and it's your race, ethnicity, and gender. If the person does not want to give it to you, the loan originator must take their best educated guess. Okay. Race, I believe it's white, or you put none of the above, Black, Hispanic, so on and so forth. Ethnicity, same thing. And then also gender, male, female, or I'm not sure if they made adjustments to the third part, but yeah. HOPA, Home Ownership and Equity Protection Act. Remember with HOPA, guys, two things. You have a high cost loan and a high year price loans. I shared this with one of the students recently. High year, so it's just a little bit more, right? ER, higher. So I want you guys to remember the 1.5, 2.5, 3.5 formula. So if you have off of what's called the LIBOR or the APOR, which is the average prime offer rate, what's disclosed to the consumer cannot exceed over 1.5% for the first mortgage. For a second mortgage, if they're getting what's called a jumbo loan, which anybody here knows what a jumbo loan is?
Oh, it's a loan that doesn't conform to Fannie and Freddie standards.
Yep. And why does it not conform to Fannie and Freddie, Steve?
Because I believe the loan just exceeds their standards of what it should be.
This money. So it's over. So every county in New Jersey and throughout the nation has a specific cap to what's called a jumbo loan. So right now it's jumped up to now it's 572. Give me 1 second because it just changed. Yes, last year used to be 548,250. Yep, 548,250 was last year, and they jumped it up this year to I'm sorry, 647. Huge jump, right? Big jump, almost 100 grand. But that's also the competitiveness of the market. You know, if you guys went over, which we'll dive into a little bit later, what the level of appreciation has been, right? For homes, you bought a house. I can't even tell you. I did this deal for a client in 2019, September of 2019. She bought a house for $298,000. Nice single family home. She's refinancing right now. Same house with very limited repairs to it. She did her thing. She made it look pretty and whatever, but very limited repairs. The house just appraised for $420,000. Crazy. $298,000 from 2019 of September to, Josh, when did that appraisal report come in? Like 7 days ago? To 7 days ago, the appraiser went out to the property, $420,000. She literally gained $122,000 in 2 years. Not even really. Well, yeah, a little bit more than 2 years. Crazy, right? And that's just, and the biggest reason is the competitiveness of the market with the supply and demand and the low supply and high demand. We'll dive into that later. But so going back to this, and then you have a high cost loan. So it's high, super, super high. And that just means that you have interest rates higher than 6.5% and 8.5%. 6.5% for the first, 8.5% for the junior. Okay. Homeowners Protection Act. I kind of went over this briefly. Whenever you guys think of this from a protection standpoint, think of mortgage insurance, right? Mortgage insurance, conventional loans. Conventional loans for mortgage insurance. And remember the two things, they will try to confuse you. They will ask you what's the percentage of equity that a client must have for mortgage insurance to be removed. It's not 80, it's 20%. Your equity is how much you've paid into it. So 20%, if you start the home with that, you don't have mortgage insurance. You don't have to ask. If you've bought a house and you think you've reached 20% of equity, Victor, you're right, you can refinance. Some banks won't even send an appraiser. They'll actually just do the removal of mortgage insurance thereafter. So that's what we're running into a lot. I'm the type of loan originator that I do. My business is very, very heavy purchase business. I'm not a heavy refi type of originator. So right now, when interest rates are going up, my business doesn't slow down. It's a little tougher to get offers accepted, but refinance business right now from last year into this year has dropped 54%. So if you're a type of loan officer who does very heavy refi, you're in a tough boat, right? You have to now catch up and play with the purchase business and try to get more purchase relationships, which again, we'll dive into more of that into the future. But so conventional. Now, FHA, guys, one thing I want you to remember, FHA, if you put less than 10% down, mortgage insurance is forever, unless you refi. FHA, if you put 10% down or more, mortgage insurance is removed on the 11th year. Okay, so again, just something for you guys to be aware of within that parameters. HUD is U.S. Department of Housing and Urban Development. Again, they're the ones that oversee all the enforcements for an FHA loan specifically. The LIBOR is the London Interbank Offering Rate. That's where you guys will pull up for a teaser rate for a adjustable rate mortgage. LP is what I went over, Loan Prospector, right? They're the ones, that's that automated system for Freddie Mac. LTV, we just briefly went over that, loan to value ratio, right? Your loan over your value gives you your percentage. Mortgage Disclosure Improvement Act, again, MDIA, gives you the opportunity to understand the timelines. MIP, mortgage insurance premium, remember, is not the same as PMI. MIP is specifically for an FHA loan. It is your mortgage insurance premium because it is everlasting, unless you put 10% down or more. MTA, 12-month Treasury Average Index, which we'll dive into. NMLS, for the big guys. So the nationwide mortgage licensing system, we will dive into this more in detail in addition to what you guys have already covered. This is where you guys logged in, right? Got your NMLS numbers. This is where all of your information will be present if somebody wants to find out more information about you, when you got licensed, who you work for. If you have any complaints or grievances filed against you, they can be found on the NMLS website. PITI is your principal, interest, taxes, and insurance. When a client makes a payment to the mortgage, to the bank, if they've elected for it to be escrowed, which a majority of them do, they make one payment to the bank. The bank is the one that will send the money to the different people who are involved in the transaction. Principal and interest, they keep for themselves, or usually banks themselves. Again, just a quick thing, understand so you guys understand, banks themselves also either service the loan themselves or they hire a third-party servicing company. So you may have a loan with bank A, but somebody else is asking you to pay them, and that's how it works. So you pay the servicing company. The servicing company is the one that pays the appropriate parties, or some banks do them internally. But when you make a payment, you pay the principal, interest, taxes, and insurance. Principal and interest goes to the bank. Taxes, the servicer or the bank will send the money to the municipality, usually every quarter or however they do it. And then insurance, same thing. They would either send them every month, every quarter, every 6 months, or every year. Okay. But you as the consumer, you only make one payment. The bank will be the one to distribute your payments accordingly. Okay. PMI, again, don't confuse it with MIP. It is private. That's the key word, right? Private, which means you can get rid of it, right? Kids who go to private school, you can get them out of private school. So that's how I remember it in my head, right? Private mortgage insurance, PMI. PMI can be removed, as we went over, 80% or automatically at 78 for conventional. POC, you guys will see on the LE and the CD something called POC, meaning it's been paid outside of closing. And there's generally two things that can be paid outside of closing, and that is usually your appraisal, because you have to pay the appraisal before the appraiser goes to the property. The appraiser doesn't care if the house appraises or not. He's going to get paid for the services he's rendered. And then insurance, 12 months of insurance for prepaids. You're allowed to prepay that on a credit card if someone else paid it for you, whatever it is. But those are the two things that can be paid outside of closing. And then who remembers what is the one fee that a bank is allowed to collect at the time of application or before you're closed? What is the only fee that a bank is allowed to charge? Come on, you guys know this. So let's think about it. When you guys go and want to buy something and finance it, what do you need to have checked?
Your credit.
Your credit. So when your credit is ran, what is the banker, the car dealership, or wherever it is, what are they looking at their computer screen?
Credit report.
Your credit report, right? And that is the only thing a bank, if they wanted to, is allowed to charge you upfront. Credit report fee. The bank is not allowed to charge you for anything else. It's against the law. I don't like to say this, but there may be a high likelihood of that being on your exam. So remember, credit report is the only fee that a bank is allowed to charge you. We don't, I know I don't for my business. We usually charge it at closing where it's disclosed because the team puts together the invoices. Some institutions may do it differently, but that is the only credit report fee that is usually allowed to be charged. RESPA is a big one, Real Estate Settlement Procedures Act. Also remember it as REXPA or Regulation X. So REXPA or RESPA, however you want to remember it. And then we're going to go into the sections. So remember, you guys went over kickbacks. You guys should have gotten over in regards to title, in regards to servicing, and all that fun stuff. So we'll dive into that more. SAFE Act's why we're here. The SAFE Act came about and mandated that people, if they're looking to get into the mortgage business, or people who are already in the mortgage business, must get licensed. Okay, they have to go through specific licensing, and it also covers in reference to compensation, which we will dive into more. Generally, mortgage loan originators, depending on the institution that you work for, you're usually commission-based employees, and you're paid a specific percentage based off of your the loan amount. Some institutions do it differently. Some of them give them a flat per loan closed. Some do a small little salary with a small percentage per closing. But the main thing in reference to the SAFE Act when it comes to compensation is you can't, from a regular direct lender mortgage loan originator, you have no vested interest if a client gets a higher rate or a lower rate. You have no vested interest if a client goes conventional or FHA. So you're going to give the client the best recommendation possible and tailor the best mortgage for them, right? Because, and I tell this to my clients all the time, Mr. Customer, I would love to give you a 1% interest rate. Trust me, but I can't because it's not available. The Fed benchmark rate is not that. This is what you get. Now, Mr. Customer, I do want you to remember interest rates. If your interest rate is 5% or your interest rate is 4%, for me personally, as an originator, doesn't make a difference. I am compensated for your loan getting to the closing table and you understanding what's going on in the transaction. I have nothing to do with you getting a higher rate or a lower interest rate. Make sense? So when they did those changes, it was the exact opposite of what used to happen in the past, to the best of my knowledge. And not everybody did it, but people had a vested interest in you getting a higher interest rate, so they made more money. Now there's no such thing. Your compensation is either fixed, specific percentage, or healthiness of volumes. Some banks do, and so on and so forth. Service release premium. Generally at the closing table, depending on the institutions that you work with, how many, do any of you guys own a home? Or your parents own a home? You may be helping them, right? Your parents, Victor, may have gotten a mortgage with Bank A, and if you don't know, it's okay. Are they still paying that same bank, or did it get sold to another bank?
No, so it hasn't got sold yet. It's still
Okay.
with the same thing.
That's great. So I'll tell you myself. So I've got two homes. One of them I bought in 2017, and it's been sold 3 times. It started with the bank that I have, and then it got sold to another bank, and it got sold to another bank. To me, though, no difference as a consumer. I just bought my second home last year. It started with my bank, and then it got sold to a different bank. Again, to me as a consumer, no difference. But for that second bank to acquire the mortgage, they're not doing it for free. They have to pay what's called a service release premium to the original banking source, and they basically pay them. I don't know what the number is, but they give them something in order to obtain that mortgage and keep it on their portfolio. Make sense? So that's what a service release premium. Usually at closing, clients will sign what's called a servicing transfer agreement that just basically acknowledges that your loan can be sold on the secondary market. Why? Because it conforms to Fannie, Freddie, and Ginnie Mae. Okay. So great when you understand this business. Like, I love this because when you truly have an understanding and you're like, holy shit, that makes sense. Now, imagine taking that understanding and reciprocating it back into your business, educating your clients. Game over. You know, you have no vested interest in them getting a higher interest rate, lower interest rate, going from one bank to another. Education beats everything, right? Truth in Lending Act, Regulation Z. So there's one lady who's very common, gives thanks. She calls it Tilla the Godzilla, the big dogs. So Tilla is truth in lending. Truth in lending, it doesn't just conform to mortgages. It covers a wide variety of different lendings. So credit cards, car insurance, so on and so forth. When we think of lending and being truthful, I want you guys to remember advertising. So when we advertise ourselves, what do we have to be? We have to be truthful. So anytime you guys think of advertising or presenting information or anything of that nature, think of TILA, because you have to be truthful. Make sense? TOR, total obligations, are the back-end ratios. So you guys remember when I explained the housing expense ratio, the front-end ratio, and I said it's just the PITI divided by the income? So your back-end ratio is also the PITI plus your total debt of minimum payments from your credit report and any financial obligations. Does that make sense? So if you have obligations such as car payments, minimum payments on your credit card, not the balances, but minimum payments on your credit cards, child support, alimony, anything that you have financial obligation, taxes with the IRS, those all get added up. And now you have your total debt, which is your PITI, plus any revolving debt from credit cards, installment notes, IRS, alimonies, child support. You take that number and you divide it by your income, and that gives you your back-end ratio. And that cannot exceed, again, for the purposes of the exam, 36% for conventional, 43% for FHA. Everybody got that? Make sense? Awesome. TRID, TILA, RESPA integrated disclosures. Here's where I want you guys to remember the 373 rule that we went over. 3 days for LE, 7 days to close. 3 days for your prelim CD to go out, must be signed to close 3 business days later. A USDA loan, U.S. Department of Agriculture. Who here remembers what's the biggest benefit of a USDA loan? How much can you put as a down payment?
0.
Very good. 0% down you can put on a USDA loan. Huge. Now, 2 things I want you guys to remember for a USDA loan. It is not for every single property. There's a specific website that you have to Google, or well, not Google, go to, and it will tell you if the property is approved for a USDA loan. It's usually very rural areas, or kind of like farm-like areas, or specific type of areas, that the property itself must be eligible to receive a USDA loan. The other thing is you cannot exceed a specific income and get a USDA loan, take advantage of 0% down payment. You cannot make 115% more than the area median income. Make sense? So 115. So if I'm a client and I make 110 grand, and the area median income for the house that I want to buy is $100,000, and I make 110, can I get a USDA loan?
Yes.
Yes, because the cap is 115 and I make 110 to qualify. The DTIs on USDA is a little bit less. I believe it's 41% or 43%. I can't recall off the top of my head. We don't really do a lot of them, but there is a little bit less of a down payment requirement than conventional being 43 and FHA being that ratio. So VA loan, guys. So VA, another benefit of the VA loan is you can put 0% down, right? It's also based off of residual income that's received from a lot of the vets serving the country. Remember the two forms. Who here remembers the two forms that you must have in order to be eligible for a VA loan? One of them starts with a D.
DD 214.
Very good. And that's essentially your certification of discharge, right? And if you're not discharged and you're still active, I believe you get a statement from your commanding officer, and then you're good. And then there's also one more thing that you need to get. It's called your COE, your certificate of eligibility. So remember, when you get a VA loan, the VA doesn't guarantee the entire amount. They usually guarantee, if I'm not mistaken, up to 25% of the home. You must get the COE, certificate of eligibility, which can be obtained online, or your lender can get it for you, that says that this person is eligible to receive a VA loan, and they give you a COE. And then the DD 214 is big. That's a certification of discharge for the paperwork that's provided to you. VOE, guys, verification of employment. So this was fun last 2 years with COVID. VOEs were very tricky. Guys, I'll tell you, in March and April, and Josh can attest to this. Josh has been with us for a long time. We would literally have a client buying a house, and COVID changed it too, because VOEs, we used to have to just do them once, and then right before closing, they made additional requirements to be done throughout, because a lot of people were losing their jobs. A lot of people were being let go. I would literally have deals clear to close, or a deal with an underwriting approval. We would get an updated VOE, and the client just got furloughed, or the client just got terminated or layoff or whatever. Deal's dead. You have no more income. So it was tricky. Now things have kind of balanced out significantly. Within that standpoint, a lot more people are back at work. Some adjustments have been made from Fannie and Freddie regarding gaps in employment, which we'll go over in a few. But remember, verification of employment, the verification gives us the idea that what the client can qualify for. It's usually obtained from their employer or an automated system that gives us a breakdown of their base pay, their overtime, their commission, their bonuses, and so on and so forth. Okay. Verification of mortgage is something very similar. If a consumer has a current mortgage, we need to verify he's paid up to date. We need to verify he's not in forbearance. Changes have been made with that too. So normally, if you get a mortgage and you have a late payment, you are not allowed to refi unless you make the next 12 months payments on time. So COVID threw a curveball at that now, and they've said that if you're in forbearance or deferment, you can actually catch up 3 months, make 3 on-time payments, and you can now refi. So a lot of adjustments have been made to kind of circumvent the COVID impact, which honestly, I'm going to be honest, I'm completely shocked that some accommodations were made. But verification of mortgage, we usually confirm they've paid on time, their taxes are paid up to date, their insurance is paid up to date. If they're receiving rental income, we do the calculation to make sure that we have an understanding of what they're actually receiving versus what they're claiming, and what they're showing on the tax return is calculated correctly. All right, guys, so I'm going to pause this